Next, we talk about accrued revenues. So we're going to recognize revenues when company provides service to send goods, transfer goods, regardless whether we have received cash or not. Okay, examples. So for example, we have completed service. For whatever reasons, we haven't been billed. Okay, we haven't billed customers, so for sure there's no payment because we haven't billed customers by the end of the period. But we're going to review those transactions and recognize the revenues. Of course, we're going to increase our account receivables. Right? Another examples. We deposit monies and we know we have earned interest revenues from the bank, but we have not yet recorded it. Review those transactions, recognize interest revenues. So let's see these examples. The company learned that the bank has decided to provide interest on checking account. Okay, and we know the interest is paid into the checking account on the 5th day of the following month. That's a key word, 5th day of the following month. So by the end of this month, this interest income has not been recorded or posted in my account. However, we know we have earned $60 interest. Okay? So we have deposited money and we know we have earned interest. Doesn't matter whether it has been posted or not, we're going to recognize these revenues. So we're going to debit revenues, the debit interest receivables, and the credit revenues. Increase revenues, increase asset. $60. So this is how we adjust accrue revenues. The same thing for if we have provided to customers, we haven't billed them because it's a busy month. By the end of the month, we haven't billed customers, but we're going to recognize the revenues with debit account receivables and the credit sales revenues. And it's the same thing for accruing expenses. Right? Expenses have incurred. Whether we have paid cash or not doesn't matter. We're going to recognize the expense for this period. Example, utility bill received, but we haven't paid. Okay, we're going to recognize the revenues, recognize the expense, utility expense, and record a payable. Employee have provided service, have earned wages, but we have not paid yet. But we can recognize the salary expense for this month. We have borrowed money, right? We haven't paid any interest, but we're going to recognize interest expense. Right? We're going to recognize income tax expenses, and we're going to pay them later. All these are examples how we accrue expenses. So let's see example of wages. Okay, employees have earned $550 during the last week of June, but we're going to pay employee the next month. Doesn't matter. We're going to recognize $550 wages expense, increase expense, and increase liability payable, wages payable. The same thing for interest expense. We have borrowed money for a month, that's 12%. Okay, the principal multiplied by the interest rate is going to give us annual interest, but we are calculating for 1 month, so multiply by the portion of the year, so 1/12, that's $120 interest expense. We debit interest expense and credit interest payable to accrue the interest expense. Right, here comes the income tax. But to get income tax, we're going to calculate income before tax. Income before tax can be calculated from taking the total revenues less the total expenses, okay, in all accounts in the ledger. All these revenues and expenses account, right? And I did all the calculations. Income before tax with $2,020. And if we do that in the trial balance, that could be more direct. Remember, this is a trial balance we have worked on. The trial balance holds all the assets, liability, equities, but more importantly, all the revenue, expenses account. So if we have the balance for revenue expenses, of course we're gonna accrue expenses later on, right? Or do the deferred adjustment. But by the end of the day, we're gonna have the adjusted trial balance. So if you look at adjusted trial balance, you take the difference between the total revenue, total expense. That's gonna be the income before tax. So we can get that directly from the trial balance. Right, next, once we have the income before tax, we're going to apply that with tax rate. For example, assume we have a 25% tax rate, multiplied by the income before tax. Our income tax expense should be $505. And then we're going to have the net income. That's income before tax less income tax expense. Of course, we need a journal entry to record this tax amount because we haven't paid them yet. So we're going to debit income tax expense and credit income tax payable, a liability. All right. So this summarizes all the adjustment we have. So I'm not going to repeat, but this is a good summary. You can take a look at it. The adjusting part could be the most difficult part for accounting. And also, be very careful. This is a place that a lot of ethical issues happen because adjusting entries require a lot of estimation. Okay? Whenever there's estimation, there will be error. There will be manipulation. The management estimates are affected by corporate pressure. For example, there are pressure to meet analyst expectations. For example, on Wall Street, send a message, or a public message saying, okay, your next month's revenue should be $10,000. That has been published by analysts. And that's a reasonable number to hit. However, you know that you're 10,000 short of that number. So what can you do? You have such a huge pressure from the market. Okay, so what you can do? Through your estimation, you may have to accrue revenues from transactions that shouldn't have been accrued. Right? You can also accelerate deferred transactions that shouldn't have been recognized as revenues so quickly, although things are unethical or in sometimes accounting fraud. Therefore, controls should be implemented very tightly on the adjusting entries. And auditors should pay great attention to those adjusting entries as well. Right, we're going to talk about earnings management related issues later when we cover revenue expenses in great details in the next few lectures. Remember the trial balance. Now it's time to complete the trial balance by adding the two columns, the adjusted trial balance. All these numbers, the final numbers after adjustment, we have the debit and the credit for each account, and total debit equal total credit, right? Also, if you look at the ledgers or the T accounts, those numbers should also all posted. All transaction has been posted, okay? And the ending numbers should reflect the adjusted balance. So we're very close to finish. Now, if we verify all these things are okay, we're going to prepare financial statement from there. And how? It's very straightforward now. We're going to prepare financial statement from the adjusted trial balance. Alright, so if we go back to the adjusted trial balance, if we look at the section, all these sections are assets, right? All these are liabilities, then they're equities. Right, all these shaded parts are balance sheet items. All balance sheet items. Then we're gonna all the revenues and the expenses. They're income statement items. Right? Just move those numbers. We're going to move those numbers into the balance sheet, into the income statement. Okay? But not yet. We're going to do a little bit adjustment. Remember, the income statement is going to affect the equity changes. And this equity changes is going to be reported or updated on the balance sheet. Okay, we're going to finish those reconciliation. First, we're going to post all the revenues and expenses amount into the income statement. You have the correct titles, right? Revenues, expenses. We have income from operations. We talk about that. We have other expenses, other incomes. An income before tax, we're going to less income tax expense. We have the bottom line, the net income. Okay, that's net income. This net income will be used to finish the statement of stockholders' equity, which shows the change in equity. All right, this is the beginning equity, which consists of two parts. The contribute capital and the return earnings. And this period, we're going to increase our net income. Okay, it's increased the total stockholders' equity. We paid $100 dividend, which reduces total equity. So this $12,075 shows the ending balance for my total equity. So we complete a statement of stockholders' equity, which shows a change in stockholders' equity. Okay, and this number will be updated in the balance sheet. Remember, on the balance sheet, all those assets, liabilities, and most equity accounts, we just copy the numbers from the adjusted trial balance. We just copy those numbers from the trial balance. The last step is to update this return earnings. And we're going to have the total assets equals total liabilities and equities. And we finish the balance sheet. Okay? So the last piece is the statement cash flows. We're going to talk about that